$6 billion. That is the number that just flashed across the institutional trading desks in lower Manhattan while you were pouring your morning coffee. $6 billion of capital liquidated from the S&P 500, liquidated from the NASDAQ, and liquidated from the Dow Jones Industrial Average in a single violent 45-minute window. They aren't rebalancing. They aren't taking profits. They are fleeing. And for the first time in a generation, that capital didn't run to U.S. treasuries. It didn't run to the Japanese yen. It didn't run to the safety of the digital tech stocks that have propped up this illusion for the last 5 years. It ran directly into the one asset that has no counterparty risk. It ran into the one asset that thrives when the geopolitical order collapses. Silver just hit $77 an ounce. And it did it while the rest of the world is burning. Ladies and gentlemen, Asian Guy here, and today we're watching the safe haven theory move from a textbook concept to a terrifying reality. Because what is happening off the coast of Venezuela right now is not just a headline. It is the trigger event that the smart money has been fearing for 2 years. And when the trade system breaks, the paper promises that depend on it break too. That $6 billion dump, that was the sound of the exit door slamming shut on the everything bubble. The index funds are bleeding, the pension funds are scrambling, and the only green light on the screen, the only asset that is catching a bid in the middle of the chaos, is silver. They told you silver was a risk-on asset. They told you it would crash if the stock market crashed. They told you that when liquidity dries up, silver gets sold first. Look at your screen. The Dow is down. The NASDAQ is down. The geopolitical risk index is spiking to levels we haven't seen since the 1970s. And silver is up. It is holding $77 like a fortress. It is shrugging off the margin hikes. It is ignoring the dollar strength. It is decoupling from the industrial narrative and reclaiming its ancient title, money. This is the safe haven surge we have been waiting for. This is the moment where the industrial shortage collides with the monetary panic. And if you think a $6 billion dump is big, wait until you see what happens when the other 100 trillion in global assets realizes that the fire exit is only big enough for a few ounces of metal. We are going to walk you through the chaos in Venezuela. We are going to break down the mechanics of this index dump. And we are going to show you why 77 is just the launchpad for a move that will rewrite the history books. The world is waking up to the danger, and the only safety is in the stack. Let's get into it. To understand why this $6 billion dump is different from every other correction we have seen in the last 2 years, you have to look at who was selling. This wasn't retail panic. The dumb money was actually buying the dip this morning. They were logging into their Robinhood accounts, reading the mainstream headlines about temporary geopolitical friction, and adding to their tech positions. They were doing exactly what they have been trained to do for a decade. Buy the fear. But the smart money? The institutional algorithms that run the pension funds and the sovereign wealth accounts? They weren't buying. They were puking. They were selling because the news out of Venezuela isn't just friction. It is a fracture. We have confirmed reports, and I am talking about multiple sources on the ground and satellite telemetry, that the U.S. naval blockade of the Venezuelan coast has effectively shut down the primary shipping lanes for heavy crude leaving the region. The mainstream media is calling it a security operation. They are telling you it is about stabilizing the region. Don't listen to the words. Look at the money. When the U.S. Navy blockades a major oil producer, that is an act of war. It is a signal that the diplomatic era is over and the kinetic era has begun. And in a kinetic world, paper assets are liabilities. The algorithms saw the newswire. They calculated the risk of a wider conflict. They calculated the risk of oil spiking to $150 a barrel. They calculated the risk of the Strait of Hormuz closing in retaliation. And they made a binary decision. Get out. That $6 billion in selling pressure hit the S&P 500 futures in 45 minutes. It broke the technical support levels that the banks have been defending for months. It triggered a cascade of stop losses that is still rippling through the market as I speak. But here is the part that proves the safe haven thesis. In a normal liquidity event, like we saw in March 2020 or in 2028, everything gets sold. When the funds need cash, they sell their winners. They sell gold. They sell silver. They sell everything that isn't nailed down to raise US dollars to meet margin calls. That is what the bears told you would happen this time. They said, if the market crashes, silver goes to $50. They were wrong, because this isn't a liquidity crisis. This is a solvency crisis. The market isn't selling stocks because they need cash. They are selling stocks because they are terrified of what those stocks represent. They are terrified of holding equity in a system that is actively entering a global conflict. They are terrified that the dollar itself is being weaponized to the point of breaking the global trade settlements. So where did that $6 billion go? Did it go to bonds? No. U.S. Treasury yields actually rose this morning. The market is selling the debt of the warmonger. Did it go to the yen? No. The currency markets are a bloodbath. It went to the metals. While the Dow was shedding 800 points, silver was ripping through the $75 resistance level like it was tissue paper. It didn't just hold its ground, it aggressively absorbed the capital fleeing the stock market. This is the decoupling. We have been warning you about this for 3 years. We told you there would come a day when the correlation between the stock market and the metals would flip. We told you that when the fear becomes systemic, when the fear is about the currency and the geopolitics rather than just the economy, silver would stop acting like a risky industrial commodity and start acting like the ultimate form of collateral. That day is today. And the banks? The bullion banks that have been shorting this market since 25, they are currently staring at the most terrifying setup in financial history. They are short the only asset that the entire world is trying to buy. They tried to cap the price at $75 this morning. We saw the spoofing orders. We saw the massive sell walls appear on the level 2 data. In a normal market, that would have worked. The price would have hit the wall and rejected. But today, the buying pressure from that $6 billion exodus smashed right through their sell walls. The volume was so high, so violent, and so desperate that the manipulation broke. They couldn't print paper contracts fast enough to satisfy the panic buying. This is what happens when a rigged casino catches fire. The people inside don't care about the house rules anymore. They just want to get their chips off the table and get out the door. And the only door that leads to safety, the only door that leads to an asset that cannot be frozen, sanctioned, or blockaded, is painted silver. But if you think $77 is the top, you are looking at the wrong chart. You need to look at what is happening to the supply of the metal while this demand is exploding. Because the chaos in Venezuela isn't just affecting oil, it is sending a shockwave through the entire Latin American mining complex. And what I am about to tell you about Mexico and Peru is going to make the China export ban look like a minor inconvenience. You have to look at the map. You have to understand the geography of the crisis. Venezuela is not an island. It is part of a continent that has been drifting away from the US dollar and American hegemony for a decade. And right next door, in the same geopolitical neighborhood, are the two beating hearts of the global silver supply, Mexico and Peru. Mexico is the Saudi Arabia of silver. They are the #1 producer on the planet. Peru is consistently in the top 3. Together, these two nations account for nearly 40% of the world's new mined silver supply. And do you think the leaders of Mexico and Peru are looking at a US naval blockade of their neighbor and thinking, business as usual? No, they are looking at those warships and thinking, we could be next. The chaos in Venezuela is triggering a wave of resource nationalism that is spreading like a contagion across Latin America. We are already seeing the headlines, buried on page 10 of the Financial Times, ignored by CNN, that unions in Peru are organizing general strikes in solidarity with Venezuela. We are hearing rumors from Mexico City that the government is drafting emergency strategic resource protection measures. This is the nightmare scenario that the industrial users have been praying would never happen. We already know China has locked its doors. We know Document 68 took 20% of the global supply off the table. But if Latin America goes offline, if Mexico decides to impose a national security export tax, if Peruvian miners shut down operations due to civil unrest or strikes, the silver market doesn't just get tight, it stops. You cannot run a global electronics industry without Mexican silver. You cannot build a green energy transition without Peruvian metal. It is mathematically impossible. And the $6 billion that just fled the stock market knows this. The algorithms aren't just reacting to the blockade. They are pricing in the contagion risk. They are pricing in a world where the Western Hemisphere's supply chain fractures. Think about the timing. This is happening exactly when the COMEX inventories are at historic lows. It is happening exactly when demand is hitting historic highs. The market has no buffer. There is no strategic stockpile of silver to release to calm the panic. The US government sold off its strategic silver decades ago. We are flying without a parachute. And the miners in these regions, the companies like Fresnillo, like Hochschild, like Southern Copper, they are issuing force majeure warnings to their clients. They are telling the refiners, we might not be able to deliver next month. That is the sentence that kills a short squeeze. We might not be able to deliver. When a bank hears that, they don't look at the technicals. They don't look at the RSI. They cover. They buy back their shorts at any price because the alternative is default. This is why silver hit $77 today. It isn't speculation. It is the sound of the world's largest consumers realizing that the two biggest taps on the silver keg, China and Latin America, are being turned off at the same time. But the story gets even darker when you look at what the US dollar is doing in response to this chaos. Because the safe haven trade isn't just about running to silver. It is about running away from the currency that is being weaponized. The blockade of Venezuela is not just a military operation. It is the final nail in the coffin of the petrodollar. For 50 years, the deal was simple. The world buys oil in dollars, the world parks those dollars in U.S. Treasury bonds, and in exchange, the U.S. Navy protects the shipping lanes. That was the contract. That was the Pax Americana. But today, the U.S. Navy is not protecting the shipping lanes. It is closing them. It is telling the world that if you do not align with Washington's foreign policy, your oil does not move, your economy does not function, your dollars are worthless, and the rest of the world is watching. Do you think Brazil is missing this? Do you think India is ignoring this? Do you think Saudi Arabia is sleeping through this? They are seeing exactly what happened to Russia in 2022, and now what is happening to Venezuela in 2026. They are realizing that holding US dollars is not saving. It is holding a hostage that can be shot at any moment. This is why the Treasury market is breaking. In a traditional crisis, when stocks dump $6 billion, that money usually flows into US government bonds. It is the flight to quality. Yields should be crashing right now. Bonds should be rallying. But look at the 10-year yield. It is spiking. It is moving up. The market is selling the crisis and the cure, and they are dumping the stocks because of the war risk, and they are dumping the bonds because the war is being fought by the country that issues the debt. This is the sovereign debt death spiral we have been warning about. When the world loses trust in the reserve currency issuer, there is no risk-free rate anymore. There is only risk. And this is where silver becomes the only rational choice. Silver is not issued by a central bank. It is not printed by a politician. It does not require a SWIFT code to settle a transaction. It does not have a blockade risk if you hold it in your own vault. It is the only asset that is politically neutral. The $6 billion that fled the S&P 500 today is waking up to this reality. They are realizing that in a fragmented world, you need an asset that has value in Washington, in Beijing, in Moscow, and in Caracas. You need an element, not a currency. And the volume of this rotation is staggering. We are seeing massive block trades in the silver ETFs, SLV, PSLV, SIVR. These are institutional sizes, 500,000 shares here, 1 million shares there. They are trying to front-run the currency devaluation that they know is coming, because they know that the only way the U.S. can afford this conflict, the only way they can service their $38 trillion debt while yields are spiking, is to print. They have to print. They have to inject liquidity to stop the Treasury market from seizing up. And when they print into a supply shock, when they print new dollars to chase fewer goods in a broken supply chain, that is the recipe for hyperinflation. Not the slow, creeping inflation of 3% a year, but the violent, runaway repricing of everything. Silver at $77 is pricing in the shortage. It is not yet pricing in the hyperinflation. It is not yet pricing in the complete loss of confidence in the dollar. When that happens, and it could be starting right now with this blockade, $77 will look like the bargain of the century. We will look back at $77 the way we look back at $4 silver in the early 2000s. But here's the problem. The smart money is moving first. The institutions are grabbing the inventory. And by the time the average person realizes that their dollars are broken, by the time the 6 o'clock news explains what is really happening, the physical metal will be gone. The dealers are already reporting delays. The mints are already putting distributors on allocation. And we haven't even talked about the short squeeze aspect yet. We haven't talked about the banks who are sitting on the other side of this trade, watching their nightmares come true in real time. Because as the price rips through $77, it is triggering a technical event that could force the biggest short covering rally in the history of the comics. We need to talk about the gamma squeeze. I know that sounds technical. I know that sounds like Wall Street jargon. But right now, it is the only thing that matters if you want to understand why silver could go from $77 to $100 in a straight line. For the last 3 months, the bullion banks have been building a fortress at $75. They sold thousands upon thousands of call options at that strike price. They collected the premiums, they paid their bonuses, and they laughed all the way to the Hamptons. They were betting that the ceiling would hold. They were betting that they could suppress the price forever. But when silver broke $75 this morning, and then smashed through $76, and then settled at $77, that fortress turned into a prison. The banks are now short gamma. In plain English, that means they are on the wrong side of the trade, and the more the price goes up, the more money they lose, exponentially. To stop the bleeding, their risk management computers automatically force them to buy futures contracts to hedge their exposure. Think about the irony of that. The very banks that want the price to go down are being forced by their own algorithms to buy. They are buying into a rising market. They are buying into a supply shock. They are buying into a panic. And because they are buying, the price goes higher. And because the price goes higher, they have to buy more. This is the doom loop for the shorts. This is the feedback loop from hell that destroyed Melvin Capital in the GameStop saga. And now it is happening to the silver riggers. But it gets worse for them, Because usually when the banks need to cover a short position, they can rely on the paper hands to sell. They can rely on the retail investor to take profits at $77, but nobody is selling. The order book is empty on the sell side. The ask is disappearing. The retail stackers aren't selling because they know what's coming. The ETFs aren't selling because they are seeing inflows. The miners aren't selling because they are waiting for $100. So the banks are trying to buy back contracts in a market with zero liquidity. Do you know what happens when a desperate buyer meets a stubborn seller? The price gaps. It doesn't tick up by cents, it jumps by dollars. We could see silver open tomorrow at $80. We could see it hit $90 by Friday. This is not hyperbole, this is market mechanics. When you have a gamma squeeze colliding with a geopolitical supply shock, the price has no ceiling. The only ceiling is the point where the shorts go bankrupt. And the rumors on the floor right now, they are whispering about force majeure. They are whispering that one of the major clearinghouses is dangerously close to failing a margin call. If that happens, if a major player defaults on their silver obligations, the game is over. The COMEX will have to settle in cash. They will admit that they don't have the metal. And at that moment, the price of physical silver in your hand becomes infinite relative to the paper contract. The $77 price tag you see right now is the pre-default price. It is the price of a promise that is about to be broken. And the $6 billion that fled the stock market today, they are trying to get their hands on the physical metal before that default happens. They know that once the force majeure is declared, the window closes, you won't be able to buy silver with dollars anymore. You will have to trade land or oil or blood for it. We are watching the capitulation of the paper market. And the only question left is, are you positioned for the breakout? Or are you going to be the one telling your grandkids how you watched silver go to the moon while you were holding worthless fiat currency? So here's the reality. The safe haven trade isn't coming. It is here. The $6 billion that fled the indexes today was the signal. The blockade of Venezuela was the trigger. And silver hitting $77 was the confirmation. We are entering the phase where the rules of the last 40 years no longer apply. The 60-40 portfolio is dead. The risk parity trade is dead. The idea that U.S. Treasuries are a risk-free asset is dead. And in the funeral pyre of the old financial system, silver is rising like a phoenix. I want to speak directly to the people who have been stacking for years, to the people who bought at 18, to the people who bought at 25, to the people who bought at $30 and watched the price get smashed back down by the banks over and over again. You were not wrong. You were just early. And in financial markets, being early is the same as being wrong, until the day you become spectacularly right. That day is today. You held the line when they called you a conspiracy theorist. You held the line when they told you that crypto was the new gold. You held the line when the entire financial media complex tried to gaslight you into selling your real wealth for digital tokens. And now? Now you're sitting on the only lifeboat in a sea of red. But the temptation is going to be strong. I know it. You're looking at your portfolio today, you are seeing the gains, and a part of you is whispering, maybe I should sell. Maybe I should take some chips off the table. Maybe I should pay off the mortgage. Do not do it. Do not trade your kinetic wealth for potential energy that is leaking. Do not trade the asset that the world is desperate for in exchange for the currency that the world is fleeing. The $6 billion dump today is just the first wave. There is $100 trillion of bond market capital that is currently looking for an exit. If even 1% of that capital tries to enter the silver market, $77 will look like a rounding error. $100 will look cheap. $200 will be the floor. We are watching the repricing of the world. We are watching the transition from a debt-based system to a resource-based system. And in a resource-based system, he who has the silver makes the rules. The Venezuela chaos is tragic. The war drums are beating. The world is becoming a more dangerous place. I take no joy in that. But we have a responsibility to protect ourselves and our families. We have a responsibility to ensure that when the dust settles, we are still standing. The safe haven surge has begun. The short squeeze is imminent. The physical shortage is undeniable. The price is $77. The destination is history. I am Asian Guy. The dollar is dying, the silver is flying, and the only thing you need to do is hold the line while the rest of the world catches up to you. Like, subscribe, and share this video. The algorithm is terrified of this information, but we are going to spread it anyway. I will see you on the other side.